On this week's episode of the Investors Corner, we are joined by Paul Hutchinson of Hutchinson and Legal Associates, and we'll be talking about how to set up a trust and why every landlord should consider having one. We'll talk about the benefits of a trust, tax implications of having one in place, and trust compared to other estate planning tools too. Now, we've had to split this up into 2 episodes because there is so much information packed into this episode and so many insights that you should know as a landlord to protect your family's future further on down the line. So make sure that you're listening to this one. Like I said, it's in 2 parts. First part is coming up. Second part is next week. So make sure that you hit the subscribe button. Don't miss any episodes on the Investors Corner podcast. Sit back, relax, and enjoy the episode. So, Paul, one of the things that we've heard over the past sort of couple of weeks, really, and we had a workshop a couple of weeks ago as well, and we were talking about wills, trusts, and other things that property investors and landlords sort of really need to look at to protect their assets. But one of the things I want sort of the listeners to know is that from you is exactly what is a trust? Because I don't think there's that educational piece potentially for property investors and landlords on exactly what a trust is, what it does, and how it protects those assets for them, really. So if you could explain that, that'd be great.
Sure. I think there's a lot of misconception about trusts. One of the things people often say is, "Oh, is this new? Is this planning new?" And what people don't necessarily understand is that trusts have been around for over 3,000 years. They're first mentioned in the Iliad, which for those classical scholars amongst us is 700 BC. Right. So the concept of trusts is not a new concept. The idea of modern trusts first came around in the days of the Crusades, and what happened was the knights were going off to fight in the Crusades, and they were worried about who was going to farm their land. So what they did was they transferred ownership of their land to a friend who wasn't going to be going to the Crusades, and said, if I don't come back, can you look after these lands, farm them, take the rent in, and look after them for the benefit of my children? Just as an aside, which is quite interesting, I think, from a historical perspective, was, of course, a lot of the knights did come back, and then the people who had had the land transferred to them didn't give it back. So all the noblemen were petitioning the king, saying, "Hey, this guy's got my land, and we haven't got it back. What do we do?" And the king actually had to set up a whole different legal system, which we now know as the courts of chancery, to deal with these disputes, because there's the old expression, "Possession is 9/10 of the law." So these people were saying, well, I own the land. But it wasn't, because they were owning it as trustees for the knights that were going away. So these concepts of trusts are not new. And I think it's when people are told about how trust can benefit, they think it's too good to be true. And if it's too good to be true, they haven't heard about it. And if they haven't heard about it, it's because it's new and it's made up. So that's the first really important thing to understand. The second thing is, what is a trust? It's a legal relationship. It's a relationship between the person who sets the trust up, who's called the settler, and they're called the settler because a trust is a settlement, because you don't transfer assets into a trust, you settle them. So you've got the person who sets the trust up. You've then got the trustees, who are the people that legally own the assets on behalf of the trust. So the settler will normally transfer the assets into the names of the trustees. So if it's a property and it's unencumbered, no mortgage, no other restriction, the land registry is changed into the names of the trustees. And the trustees look after the property on behalf of the beneficiaries, who are the people who ultimately benefit from the trust assets. Now, just people do wonder, can the settler be a trustee? Can the settler be a beneficiary? Yes, they can. There's all sorts of permutations. But depending on the type of planning that you're doing, sometimes the settler shouldn't be a beneficiary for tax reasons, which I'm sure we'll come on to a little bit later on. But it's not complicated. It's a legal arrangement. It's a piece of paper. And people can set up trusts either by their will, which is what a lot of solicitors and estate planners and will writers will do, which hold assets upon death, or if you want benefits during your lifetime, because obviously you don't want to wait until you've died, so inheritance tax, asset protection, you can set up a trust during your lifetime. And that's basically all, that's what it is.
So trusts and trust funds, I think, have an image of being for the super wealthy, not the maybe the middle class homeowners who have a buy to let or own a small business doing what they do. Our estate planner in the office had a client on the phone last night, which I was sort of party to the phone call. His builder turns over a couple of £1 million a year, got 2 children from a previous relationship, and his first question to the estate planner was, should I trust my partner? Because I'm just going to give my money to my partner if I die. And I think the image, and it's going around in my head, that TikTok theme of looking for a man in finance, trust fund, 6'5", blue eyes, is the kind of image of trusts.
Yeah.
When who should be looking at these options?
I think, it's a sad indictment that the image of trusts is designed for the super wealthy.
You're thinking Eton College, you're thinking Oxford's, you're thinking Boris Johnson.
Think of the Duke of Westminster, the original, Gerald Grosvenor, died in 2016 with a $9 billion estate, didn't pay any inheritance tax because of trusts, effectively. So everyone thinks super rich, benefit from all of this.
Yeah,
great planning, not suitable for the mere mortals like us who don't have £9 billion of property floating around down the back of our sofa. I think that is definitely one side of trust planning. People do use offshore trusts, complex trust funds for the super wealthy. But if you think about, just take an example. If I've got a 15-year-old child and I die, and I leave a will and I say I want everything to go to my child, there's a statutory trust automatically put in place because somebody can't benefit till they're 18 years of age. So just in that simple thing, if I had a bank account with £6,000 in it and that's it, there would be a trust. So you go right from that bottom end example through to the Grosvenor family. Trusts are suitable for everyone who wants to protect something, whether it's their £100,000 property in a mining town in South Wales, because that's obviously where house prices are lower, or in the north of England, or they've got a £20,000 personal injury settlement they want to protect, or they've got a £450 million property portfolio. They're suitable for everyone. I think, as well as the stigma or the stereotype, it's the cost of setting these things up. I know of firms that charge £8,000, £9,000, £10,000 per trust to set them up. I'm not saying that's grossly expensive, but you have to look at the cost versus the benefit of what you're getting. And obviously, if it could save 40% on £1 million, 400,000, inheritance tax, well,
it's a drop in the ocean.
It's a drop in the ocean. Yeah. But then in the society we're in today, they might go to a different, trust lawyer or estate planner or financial advisor, and they say, well, I can do the same job for £900. So what's the difference between £8,000 and £900? And that's the difficulty with anything. If you want to go and buy a car, you could buy a £500 clapped out Fiesta or a £500,000 Bentley. They still have 4 wheels, and you can still drive them. So my advice to anyone is don't think that trusts are for the super rich. Yes, it's likely to cost more than a basic will, and if you were expecting to speak to your estate planner about wills that might cost a few £100s, don't expect that to be the bill at the end of it if you're going to involve trusts. But if you are protective of what you've got, because it's a second relationship, you may think, sadly, your relationship may come to an end, you've got stepchildren, you've got financial difficulties. Even think about this. If I've got a child living abroad at the date of my death, if my son was living in France, how is his inheritance going to be taxed? If I leave him my entire estate, how is his inheritance going to be dealt with under French tax law? And when I've asked a client that question, they've said, well, I don't know.
Oh, well, yeah, that is the answer, isn't it?
Well, that is the answer. Although one client said to me, well, I think they get this, this and this. And I said, yes, but that's the law now. When are you going to die? What's the law going to be in place? So she put a basic trust in her will that said that the son could take the legal advice and financial advice in the UK, in France, at the time of death, and the trust would be protective. And that estate was only a couple of £100,000.
Yeah.
So they are for everyone. And the only piece of advice I can give is that if you've got, trusts are a very, very specialist area. And like anything with it that involves specialism, you're likely to pay a little bit more for the advice and implementation. General lawyers, those that do their conveyancing, they do the family law, they do a bit of will writing, they're not likely to have a full working knowledge of trusts. So always go to a specialist, whether that is a solicitor, whether that is a chartered tax advisor, whether that is a good estate planner who's focused purely on trusts, will trusts throughout their practicing career. It doesn't have to be your local solicitor. And that's one of the things I get asked a lot. They say, why didn't my solicitor think of this? Now, I started my career as a solicitor, so this isn't a dig at solicitors, but they're often portrayed as the professionals who know everything or should know everything. So are accountants. Why did my accountant not advise me that going into an LLP was a good idea for my property portfolio? Well, the accountant just runs the books.
Yeah.
My father was an accountant. He knows nothing about this sort of tax. So people hold their professionals, their trusted professionals, in very high regard. And so they should. But those professionals don't know about everything. And if you're a landlord or any sort of professional, you need a good lawyer, whether they're Silex, whether they're an estate planner, whether they're a solicitor. You need a good tax advisor, you need a good financial advisor, and a good accountant. And it's not overkill to have those professionals working for you because they all bring very unique skill sets and they should all be able to work together to give you that best advice.
Yeah, I think we've come to that point in the south of England, particularly where average house price is £500,000 in most towns. So you've got a lot to lose. And the flip side of that is your kids or your grandkids have got a big mountain to climb to get onto housing ladders and to get ahead these days. So the protection of those assets for you to pass down is really, really important. And as you said, the modern world produces these slightly more complex, shall we say, family situations. So many people they're on second marriages, so there's more to protect. Or if they pass away young, they know or think their partner will remarry, and therefore other people will be affected by their wealth. Or my personal situation, there's a lot of people, my brother has no children, so my mum's at the point of estate planning where she wants to give equally to me and my brother, but the only grandchildren she's got are on my side, so she wants to protect something to ensure that my son, her grandchild, receives the money in a flow rather than it going to my brother and just stopping. So there's these almost year 2024 issues that maybe bring trusts more into focus for I would put myself in the normal category.
Yeah, I totally,
in that sense.
I totally agree. Having met you for a few, you are definitely in the normal category.
I'm definitely not super rich.
No.
There's always time.
But I wouldn't. 2 years ago, before I was exposed to these kinds of conversations, if someone said, "Do you want to put a trust in place for your son?" I'd have gone, "Ooh, fancy,
shiny."
Probably not for me. Don't need that kind of thing. That's, like you say, that's for dukes and Eton graduates. It's not really my place. Because I know my place in society in that way. So that's what it kind of means to me, and it's why we try and sort of just push that home on this podcast. Is I think most of the listeners are like me. You own a small business, you own maybe a second property. There's a couple of buy-to-lets floating around in the family as people have sensibly invested money rather than inherited millions and millions in doing it.
Yeah, I agree. And I think the other thing to remember is that the complex dynamics that you refer to. I don't have children myself, and it's there's the bloodline in my family stops with me. And you think about 20 years ago when that wasn't the norm. People always had children, or they tended to stay together in first marriages. But I think the key thing here is that the inheritance tax allowance has stayed the same, the basic nil rate band, since 2009.
Yeah,
£325,000.
Yes,
and you think about how the average house price has gone up.
It was a huge increase in tax in a stealth way, isn't it?
Absolutely. Yes, they brought in the residence nil rate band in 2017. Obviously, that came into full effect in 2020. But that only benefits people who've got remain residents worth at least 175 grand and that have got lineal descendants. So it was completely contrary to the original 2010 election promise of the £1 million inheritance tax allowance. And of course, that's not a criticism per se of the Conservative government at the time, because every party makes promises and then they deliver with a slightly roundabout way of having achieved it. But fundamentally, 325 grand is all you can pass on as a basic nil rate tax band. And if you then, you say, okay, I got my 175 on top, but I don't have children. So no, I don't. I haven't got a predeceased spouse, so I haven't got the additional 325. Or, I've got assets that qualify for business relief. So whether that's investments or property that, or businesses, that then take me over the 2 million threshold, where you start to lose that residence nil rate band anyway. Basically, unless you're worth 325 grand or less, you're snookered with inheritance tax now. And it looks like the Labour government are going to further really tighten up inheritance tax rules, potentially on pension funds. So whether you're an investor, or whether you're a business owner, or whether you're a property owner, we're basically stuffed for the next few years, because that's when the basic allowance is due to go up 28, 29. So, yeah.
So is that the advice? Don't die until 2028?
Cryogenically freeze yourself. If it's good enough for Simon Cowell, it is. But it's not just inheritance tax that's the issue. I mean, nowadays there's this huge furore about care fees. Dilnot years ago, it seems like years ago now, proposed a cap on care fees of 72 grand, I think it was. And then the now deposed Jacob Rees-Mogg debunked that and said, well, actually, that was the cap on the care element. By the time you've paid 72 grand's worth of care, you're going to have paid 150 grand in total for the bed and breakfast element. So they scrapped that cap. And people who've had experience, and that is something I've had in my family. My grandmother was in care, and my mum and her sister basically were disinherited of a bungalow. So people, it's not only for people who are worried about tax, but are worried about the £1,600 a week's worth of care fees. And that's, again, where trusts can come in. Now, this is a very contentious area, because there are professionals out there who say, do not touch trust with a 10-foot barge pole. Trusts do not work for protection of care home fees. And I would actually, I don't stick my head above the parapet very often and say, that's not true. I've got clients who have put their houses in trust, not even through me, but they have been disregarded by the local authority because they were in trust. Now, the key, and I think where the certainly the legal press has generated a bit of a storm, where people are now a little bit concerned, is that trusts can be missold. A bit like pensions and pension transfers were missold. There are individuals and companies out there that for £6,000, £7,000, £8,000 are basically guaranteeing that Granny can put her house in trust and it won't be sold to pay for care fees. There's no conversations about deliberate deprivation of assets. There's no conversations about the Care Act and is the need for care being foreseeable. And for, again, traditionalist solicitors, it's a very contentious and very dangerous area. My view is, if advised properly and the family are made aware that it might not work, that deliberate deprivation is a possibility, then I don't think you're misselling the trusts. And when they do work and they can protect 200, 300, 400 grand house, which is all they've got, what a powerful tool. So, anyone that's thinking about using trusts, and they maybe have read, gosh, such and such a solicitor saying that they're bad, they're not. But they have to be, like I was saying earlier, they have to be properly advised on by someone who knows what they're talking about, who will advise you not only of the pros, but also the cons. Potentially, the trust could be subject to entry, periodic and exit charges. For example, trusts have a very punitive tax regime post-2006. That has to be discussed. If there's income going into the trust, it could be taxed at 45%. So it's about getting that holistic advice about the pros and the cons of trusts. But if you get that advice and you still think it's the right thing for you, absolutely, they're fantastic in this complex day and age where tax allowances are dropping down, tax burdens are going up, and the opportunities for tax planning and asset protection are becoming fewer and far between.
Yeah, what's the impact on tax liabilities on a trust then? Is it sort of the same as normal, or is there a way of getting around paying certain tax liabilities? How does that set up?
Well, let's talk about the three main taxes. So within income tax, the bit that I I do smile when clients say, I've done some Googling, and of course they've already Googled about their headache and found out
They've already got cancer.
They've already got a brain tumour. And we shouldn't joke about things like that, because actually that is true. But Googling is the worst thing you can do, because people, for example, were saying, well, I see that trusts are subject to a 50% rate of tax. Well, A, that related to income tax only, and B, that was a few years ago. So, as with everything on the internet, there's stuff that's out of date. Yeah. Fundamentally, income into a trust, if it's not disposed of, which I'll come back to, is taxed at 45%. Okay? What you can do is two things. It goes into the trust, tax is paid at 45%, but when it pays out to a beneficiary of the trust, they can reclaim the tax as a tax credit. There's a form called an R185, and the beneficiary completes that and says, hey, I'm a 20% taxpayer. I'm getting this income that's already been taxed at 45%. I want to reclaim some of that tax. Now, my understanding is that they don't actually give you a cheque with some hard cash in it. Yeah. They actually give it to you as a tax credit. The other thing that you can do to avoid the 45% tax rate is the trustees can agree to pay the income directly to one of the beneficiaries who declares it on their own personal tax return. Right. So, why would you go through the 45% and then try and get money out of HMRC, which is like trying to get blood out of a stone? Just pay it directly to the beneficiary. So income tax is an issue. Now, of course, if you're putting your family home into a trust, there's no income on it anyway because you're living in it. So this mainly applies to rental properties. The trusts are subject to what we call the relevant property trust tax regime. Don't try and say that after a few glasses of wine.
I was just trying to
Yes, the RPT. Yes, that
spinning,
one.
Yeah.
So there's the trust tax regime. It is actually part of the inheritance tax legislation. And basically what it says is every 7 years we can put, as individuals, 325 grand into a trust. Okay? And I said that allowance renews every 7 years. If you were to put, let's say, 400 grand into a trust on day one, the excess over 325 grand will be taxed at 20% immediately. Okay? So, hint number one, don't put anything more than 325 grand into a trust.
Yeah.
Obviously, if it's a husband and wife, they can put 650 in between them. So if an investor has a buy-to-let property that he owns in his own name and he wants to put it into a trust in isolation, gift 50% of it to his wife, because transfers between spouses, there's no capital gains tax. And then they can each put their 50% share into the trust. That's how you avoid what they call the entry charge. Okay. Then every 10 years, trusts are revalued, and then there's what they call the periodic or 10-year anniversary charge. And the way it works is whatever the inheritance tax allowance is at the time of the 10th anniversary, so again, at the moment it's 325, if the trust fund was valued at 400 grand, the excess over 325 is taxed at 6%. So it's not such a punitive tax. And of course, if your trust fund has increased significantly, you're going to have to think about paying a bit of tax, because it's not all about getting everything tax-free. I'm a great believer that I like to help people reduce their tax, not eliminate it.
Yeah.
And then you've got what they call the exit charges. And obviously that's when stuff comes out of a trust. Now, if you paid no entry charges because you kept your initial deposit under 325, then you won't pay any exit charges in the first 10 years. The reason for that is the exit charge fundamentally is a fraction of what you paid for the periodic charge. So if you didn't pay any entry charges, didn't pay any periodic charges, you won't pay normally any exit charges. Right. So you have to think about the relevant property trust tax regime. Then you've got capital gains tax. And this is the biggie for people who've got rental properties. First thing to say is it's not quite so bad now, but if you go back 3 or 4 years ago when we had personal capital gains tax allowances of 11, 12 grand, the capital gains tax allowance for a trust was 50% of the personal tax allowance.
Right.
So if the trust eventually sold the buy-to-let property, they would have only had 50% of the tax allowance, the annual tax allowance, to offset against it. But nowadays, because it's only down at 3 grand, it's not such a huge, punitive charge, as it were. But the biggie is putting a rental property into a trust is a disposition for capital gains tax purposes. And what I mean by that is the legislation says thou shalt pay capital gains tax if you sell, transfer, or dispose of a property. So even just transferring it into a trust or giving it away to a non-spouse, you're going to trigger a capital gains tax charge. So if you put it into the trust, capital gains tax to pay. Obviously, you can pay it if you want to, if the charge is very small or if it hasn't increased in value very much. But most people who've got buy-to-let properties have had them for quite a while, and that might be pregnant with gains of tens of thousands of pounds. There is some relief in the legislation. It's called holdover relief. And basically what it does is it defers the payment of that capital gain. Okay? That holdover relief is claimed, it has to be claimed within 4 years of making the transfer into the trust, and it's claimed at the same time that you go online and do your own personal income tax return. It's a part of the income tax return, the declarations about capital gains tax and holdover relief. But the problem is, to claim holdover relief, you put it into the trust has got to be what we call settlor excluded. And if we rewind back to the beginning, what is the settlor? It's the person who set the trust up. So if I'm the investor and I put the property into the trust, I can't be a beneficiary. What does that mean? Rental income, I can't get the rental income. The term settlor excluded is even wider than that, because it actually includes the settlor's spouse. So if I own a rental property in my name, I put it into a trust, I can't benefit from it, nor can my wife.
So you're effectively giving the property away
to the trust.
Yeah.
Exactly.
Yeah.
The only people who can be beneficiaries, obviously, well, anyone can, but the only person in the family is grown-up children. So in essence, what would happen is property would go in, holdover relief, the grown-up children are going to be the beneficiaries of the trust. They, obviously, like we said, can pay tax on the rental income. And the only thing that you've got to be so careful, because if the parents benefit from that rental income in any way, shape or form, it's going to be classed as what they call an associated operation. So they could get stung for the capital gains tax. But I have heard it mooted by accountants and top tax councils that if the children, let's say it was 20 grand a year, if they then paid for the family holiday out of that money and mum and dad happened to go on the family holiday, it probably wouldn't be an issue. But if they started giving the rent back, or there was an obligation, certainly a binding obligation to give the rent back to mum and dad, that's...
Yeah, if a direct payment
exactly
is worth £1,000,
that's going to be contrived.
Transferred, that's quite clear and obvious, isn't it?
It's at the worst, that's going to be tax evasion.
Yeah.
So the problem with trusts and buy-to-let properties is it's okay if you don't need the rental income.
Mm-hmm.
And a lot of people who've got maybe more than 2 or 3 buy-to-lets are going to have, equitable interest more than 325 grand.
Yeah.
And from an inheritance tax perspective, it takes 7 years after going into the trust to be IHT free. So if I had, £1 million worth of property I wanted to get out of my estate, I'm going to have to wait 21 or 28 years for that to work and not touch the rental income in the meantime, which is why what we look at nowadays are corporate structures. So limited liability partnerships and limited companies where we can actually undertake some tax planning with those corporate structures, which we can always come on to a little bit later.